gave up managing billions to become a better investor. Episode 15, Cash Level Realism for an Investor. Hello. Last time on the podcast, I talked about central banks and where potentially the United States with the Federal Reserve or the EU with the ECB might be moving. And I guess I got half right because the Federal Reserve chose not to increase interest rates. I think that was a correct decision. And my view, as I talked about then, would that be keeping interest rates unchanged for the rest of 2023? I wasn't too surprised that the ECB decided to raise rates, except if it was up to me, and I'm obviously not on the ECB board, so I guess it isn't, but if it was up to me, then I wouldn't raise interest rates. But they're still concerned about interest rates and where they're going and everything else, and that's just an interesting sort of shift, really, because the ECB was very late in raising interest rates a couple of years ago or so, much later than the Bank of England, much later the Federal Reserve, etc. They seemed more Japanese-esque, Bank of Japan-esque in terms of keeping ultra low, actually negative interest rates for a lengthy period of time, many, many years. Initially when it was probably justified, and more latterly when perhaps it wasn't. And then finally, they did start raising interest rates, and they've been, I guess, a bit behind the curve. So I wasn't overly surprised. But again, choosing the correct level of interest rates, choosing the right central bank policy is, to me, all about looking forward. And I know central bankers and the teams there do look forward, but I just think they haven't looked forward kind of sensibly enough. We'll see who's correct in 6, 12 or 18 months' time or so. Anyway, I was also I touched briefly in some previous podcasts about some of the interesting shifts in markets. The fact that the fear and greed index has generally been sort of pushing up from sort of times of fear, clearly fear during the times of general market volatility, particularly in the UK market, but across the world generally too, at times in September and October last year. We entered the year, as always, where some people were pessimistic or optimistic. I was optimistic, and that's kind of worked for equity investors. And I guess what I've observed in more recent times is that people who perhaps started the year as being pessimistic have suddenly become much more optimistic, which is always a kind of interesting moment. You may have seen just over a week ago, the fund management survey, the monthly fund management survey from the Bank of America talked about, again, great optimism or rising optimism, lots of positive views, of course, towards the technology sector. Clearly, the world of AI and related has meant that tech stocks, after having a very bad 2022, have generally had a very good so far 2023. I guess that's technology for you. We've touched on AI and related over previous podcasts. I won't talk about that at particular length, but I think since those thoughts a couple of weeks ago or so, tech stocks have pushed on even further, generally. And that's kind of interesting. The VIX index, sort of the volatility index, if you like, has got to levels we haven't seen for a while. And obviously, when we've got low volatility and high levels of optimism, that's a sort of an interesting moment. And I would sort of normally say, as a sort of fundamental investor, if you like, across multi-asset classes, that of updates from central banks for bonds, and clearly the next set of corporate earnings season, which is due to start in just under a month's time, are going to be, as always, fascinating. We've still got some central bank views to look out for. Clearly, I could talk at length about the Bank of England, but I'll maybe just leave the Bank of England to give their thoughts this week as I speak on Thursday, and we'll go from there after that. So what I thought I'd talk about today instead was cash, and it was kind of inspired a little bit by the aforementioned fund management survey, which came out a week or so ago as I speak. And what's kind of fascinating, and by far and away the most fascinating graphic in the fund management survey this month, was not just the fact that average cash balances by the average fund manager responding to the questions in the fund management survey, how they reacted, unsurprisingly, less cash, as we've talked about already, more optimism about equities, more optimism about technology sector equities in particular, and a general view that you've got to put money to work rather than letting it being wound down by inflationary issues and related, which is all fair enough. And I kind of started the year from that view in any case. So kind of some people are sort of playing a little bit of catch up. But what I find really interesting is looking at the last 25 odd years. So since sort of the 1997, sort of 98 sort of period. And I have to say, Bank of America do a pretty good job in providing some interesting data. And what's fascinating, of course, is that the average fund that they take results from has over that period shown typically a kind of a 4 to 5% sort of cash balance. Now, you've always got to have a bit of cash. It's not because you're paying the bills per se, although I guess technically there are a few bills and brokerage costs and related for the average fund manager. But it's more because of the fact you want a bit of dry money. You want to have something if suddenly one of your favorite shares becomes very cheap, you have some money to buy more shares rather than having to sell something in order to buy something. So I wholly understand how, and I know this as a former fund manager myself, I wholly understand that you generally won't have zero cash in your fund. And always, it's kind of always striking when people tend to have a high single digit or a circa 10% rating, because typically, it certainly used to be the case for most funds, you typically can't have more than 10% cash, because if you are having more than that, not only are you making a very big bet, if markets generally go up and you've got a whole load of cash, then your other stock picks have got to be great. Otherwise, you're probably likely to underperform quite notably. But generally, from a sort of a general fund management review perspective, certainly internal kind of monthly discussions and related with compliance officers and the like, a very overly kind of cash-centered view, that kind of 10% plus allocation, you definitely need to be signed off. And typically, most funds, certainly when I was managing a fund, you could have a 10 to 20% position, but it was an over bet, if you like. And anything above 20% was just beyond the pale, just wasn't going to happen at all. Not unless there was some extremely strange situation where you needed high levels of cash, particularly if you ran a fund which was itself maybe with high levels of liquidity and related, just like I used to run. So typically I used to run, even if I was cautious, the investments that I would like to look for, both from a general allocation perspective, equity, bonds, and related allocations, even if I was cautious about both of them, couldn't find a range of interesting companies to invest in or corporate options to utilize, there's always something to do. And if you're trying to beat a benchmark, an index, or whatever it might be, clearly even that benchmark probably only has, if any, cash allocations, no more than a sort of a low to mid single digit level. So you're not really taking much of a bet if you have sort of 5-8% cash levels, even if you're cautious. And clearly, as we all know, depending on what you choose as an investor, if you want to be cautious for whatever reason, you can center yourself on dividends. You could focus on certain sectors which are more cautious. Frankly, as you know, one of my favorite alternative allocations is matters such as gold. And clearly that's something which can perform in different ways in different styles. And if you look at the last podcast, I talked about some of the different sort of correlations that different asset classes have. For example, whilst bonds and equities have a small positive correlation, that's certainly not the case with, let's say, equities, bonds versus commodities and gold and stuff like that. And no doubt, Bitcoin and crypto lovers will have a sort of an akin view. Certainly, crypto is different, to say the least. But anyway, what I find fascinating about the Bank of America information I came across last week was not the fact that cash balances have fallen from sort of something on the lines of a 6% odd level to sort of a 5% level. So kind of gone from above average, which I guess would have been the norm back in sort of September, October last year, when you had a bit of local volatility in various markets and particularly in bond markets. And that, as markets have gone up, people have been kind of induced to put money to work for managers and related. So that 6% has gone to sort of 5% and in some cases a bit lower. All kind of perfectly normal at a certain level, not particularly taking huge bets either way. Far more interesting to see, I would say, where that 95, 96 odd percent of assets are actually allocated. But as we're talking about cash this time, let's just focus on that. What's fascinating is if I look back through the sort of last 15 years, that's been a pretty normal thing. It can sometimes go to sort of a 3.5% to 4% level, sometimes go to a sort of a 6% level. But as always, a bit like the fear and greed index, when it's at that sort of sub 4% level, that's when people were highly optimistic and excited. That's when they're getting greedy, and that's probably when you should be getting fearful. And similarly, when it's at the sort of six and change percent level for sort of asset allocation by diversified fund managers, that was when you should be saying, wow, people are getting a bit fearful now, therefore I should be getting greedy, akin to what the correct view to do in, and you can see it on the graphic actually, interestingly, in sort of the time of the Ukraine attack from Russia. Unsurprisingly, cash levels went up, but actually, as we've talked about before, that was a great opportunity from a purely investment perspective to find ways to put money to work. Clearly a terrible time from a geopolitical perspective, and clearly struggles and challenges in Ukraine still sadly continue, and foolishness by the Russian leadership is still apparent. But similarly, when you had generalized sort of market volatility in that October period, that's where opportunity to put money to work. And that's what you've got to look forward to. Now, it's kind of interesting to see where we are now. It sort of suggests that, kind of akin to my general view where I started this year, that it still makes sense to have a generally equity overweight allocation. That's my view on life. As you know, my view on your sensible bond allocation is sort of your age minus 50. That's still my view. So a 50-year-old should basically only at that point be starting to buy some bonds, whilst a 30-year-old should be equity focused. And if you're looking for alternatives, that's where the world of commodities and gold and infrastructure, and I guess if you're crazy enough, crypto and whatever, come in. As for cash, I've always been, as I said, a person who generally has a low cash allocation, unless I've got some particularly strong views on shares that I've just sold and I'm still waiting for something else to come to an attractive level. But typically, I'm the sort of person who has less than 3% cash. There are things I want to be doing with my pension fund, which isn't cash centered. What's fascinating is this is, I say, that kind of typical investment allocation area of sort of 4-5 odd percent or a little bit either side has been the norm for sort of the last 15 odd years. So even though I've talked about the sort of the crazy 2010s, the fact that everything, in quotes, everything, not everything clearly did go up, but it felt like every asset class did rather well. And that does feel like an aberration to me, how the 2010s performed. But we'll put aside, and we've talked about before, the crazy world of super low interest rates and great hope that it's going to last like that forever, because to me, it's the aberration. As I said, it's not the norm. But that's another issue we talked before, and no doubt we'll come back to again. But what's kind of fascinating is, over the last 15 years, the 2010s, the start of the 2020s, even before we got to that 2010 point, that was pretty much normal. The difference in the shift has been if we look over the 25-year period, because what was interesting was that the only time we've seen a distinctly higher than a sort of a circa 6% max kind of cash allocation was back to the early part of this century. The fact when we had the dot-com bust, we had the volatility of markets in the sort of really starting in the year 2000 and certainly cracking on until late 2002, early 2003. That was the last time when we really had a significant kind of circa 8% plus sort of average cash allocation as per measured by the Fund Management Survey. And I find that kind of interesting, really, because I know that we can find all individual funds that have had much more cash than that, apparently at smart times when markets are a bit volatile and the like. But the norm, as captured by the Bank of America Fund Management Survey, it's kind of striking. And it seems to me as if the investment world is getting, for want of a better word, smarter, in the sense that it realizes that you can't run a fund now holding a large amount of cash. And as I said, even when I was a global fund manager, sort of from the sort of various points of the kind of late 90s and into sort of the first 15 years old of this century, what was apparent to me, as I said, was that to have over a 10% cash position, it was an overt bet and you had to get it through compliance and all of that stuff. And my feeling is some of these shifts reflect the fact that the role of compliance, the role of analysis, appraisal, has this fund performed well or not, has become much more apparent. And in ways, that's a positive progress of the fund management industry. It's also a reflection of the fact that there's much more competition nowadays, be it through technology, computers, appraisal, clever websites doing stuff and related. It used to be that your fund manager was sort of suggested to you by a friend of the family who was experienced in the city matters and stuff like that. But I think over the last couple of decades, possibly before that, people have started to realize that actually you can do an awful lot yourself. You can work things out. You don't need to be told by an, in quotes, expert. You can actually, as long as you work hard, sensibly, thoroughly, you can do an awful lot of stuff yourself. And certainly with the preponderance over the last 30 years of a huge amount of free data out there, as the internet and related have become apparent, that is a remarkably easy thing to do. That's not to say that professionals and related don't have an important role to play, because patently they do. Particularly, I would say, concerning allocation, what's relevant for you in your particular age, preference, lifestyle, what you're trying to achieve for your friends and family and related. That's absolutely fine for some professional insight. But honestly, genuinely, do I believe that you, a smart individual, can learn how to actually add value yourself through hard work and common sense? There's a lot in that nowadays. And I'm kind of not surprised to see how the fund management survey has shifted, because I think even the average fund manager of the average institutional fund out there has realized that you can't muck people around so much nowadays. Either it's the bunch of competitors out there who have funds which are wholly invested, particularly if markets have been quite workable or investable, as I guess has generally been the case for large swathes, let's face it, of, beyond the last 25 years, the last 40, 45 years, you'd have to go back to the overt volatility of lots of the 1970s to get to a point where you would be a bit scared of being particularly an equity investor over a sort of a multi-year time period. Because, of course, that's always the key, isn't it? That there is always volatility in markets, and we all understand that on a single day, it's a flip the coin, almost a 50-50 whether markets will be up or down, 50.5% up, 49.5% down. But as those time periods go out to a month, a year, 3 years, 5 years, 10 years, those probabilities go unsurprisingly much higher. And ultimately, and certainly if I look at the US data, which is the most thorough over sort of more lengthy time periods, they can't spot, despite craziness in terms of some of the volatility of the 1930s and the like, they can't spot an over 20-year period where you would not have made money if you'd have been just a random investor at any point in the market. It's quite fascinating, really. But that's the way the capitalist and related world is. It ultimately does give you opportunities and a payoff. And obviously the key is how you allocate those monies, number one, but also the fact that you stay in the game. And that's not that I'm not sort of saying you should, oh my goodness, you buy something, you hold it forever. It'd be nice to say that. And there are some sectors and stocks and related and other factors where clearly that has been the case, but that's in hindsight. In reality, I guess, and as you've heard through this podcast already, I'm an active investor and I do change stuff. It's not, certainly I'm away from a day trader, but I'm also away from a super long term. We absolutely must keep this fixed, this very rigid allocation and choice of investments. I do change, and typically for me, a long holding period would be a number of years. And I think that's perfectly prudent for somebody of my approximate age. Certainly anybody who is a number of years from retirement, a number of years before they actually start tapping their pension, should be thinking like that. And as we've discussed before, the world is patently going to change an awful lot in the rest of the 2020s and in the 2030s and pretty much every other decade that I will ever see. And that's exciting. It may feel worrisome. but it's exciting, actually. It's exciting in the sense that not everything will be good. There'll be plenty of foolishness and idiot politicians and related foolish people in charge of countries and related. But ultimately, I am a glass half full person. I am excited about the future still. And as an investor, I would still be, certainly from looking at my personal pension fund allocation, which I think I've broadly shared with you, is something along the lines of 90% equities and just under 10% gold or gold-facing allocations. And at the moment, because I still haven't quite hit the age of 50, I've chosen not to have any bonds, and I've got a little bit of cash there just in case I find a few new excitements which just suddenly occur to me, and I don't want to sell any of my current holdings which haven't quite hit my targets or related that I was looking for. So I find that kind of, in a way, even though the fund management survey is something which a lot of people say, well, a bit like the front page of The Economist or something like that, you always want to be doing the opposite of what you read on there. That the reality is that I actually quite like this graphic. I quite like the fact that over the last 25 years, we've generally seen cash allocations go down, reflecting what the global fund management industry is doing. And I think it goes beyond the fact that people suddenly become very bullish, because actually I can't spot a moment in the last 25 years, despite some very bullish times in the equity markets in particular, but frankly across the whole financial markets. Let's face it, bonds have generally performed rather well since sort of the early 1980s. But if you look at the allocation to cash, actually, even at the time of peak .com excitement, it was still back at that kind of higher single-digit level. And I can't believe it was because people were saying, well, I'm worried about these internet stocks going up too much in 1999. That was not what was happening. People were trying to allocate as much as they could. But the funds and the fund management industry, they were saying, well, we've always got to have a lot of cash because just in case our investors decide to sell, maybe they had some memories of a bit of volatility in 1998. Maybe they were too cautious to put that to work. Maybe many other things. My feeling is it was just a reflection of the fact that a typical allocation was 10% cash, it pays you a dividend of some form, you then have 30, 40% in bonds, and you have 50% in equities, and it's all very rigid and frankly very old school. So I'm not surprised to see that shift and that change. My personal view is that cash does play a role in your personal financial life. And it's obviously actually before your pension fund, of course. It's that prudence of having cash in order to pay some bills and related, given stuff can change, jobs and related and other matters can come up. And you don't anticipate them, unfortunately. And a little bit of cash for that is perfectly prudent. A number of months of normal bills and related is, to me, more than enough. What, of course, you should be doing is with the money that flows from your jobs or other forms of capital you may have, it is, of course, to be saying, well, I pay my bills, whatever they may be, but I also invest some money into my pension fund because, it's not just all about, well, I must buy a house, and therefore once I've bought that, I must buy another house. Far more prudent is to say, let's start the pension early. Let's, of course, save money and buy a house, because I think that's still a smart thing for people to do from a purely lifestyle perspective. Far easier to change and keep it how it is, your own house, rather than one which is rented. Another subject, no doubt, to talk about housing markets and certainly too high levels of enthusiasm at various points over recent years in that space. But in terms of cash per se, yes, have a little bit of cash for your general bills you can't anticipate, or general bills over the next quarter or something. But otherwise, cash kicking around, and I know that's become trendy now, that cash is paying a better rate of interest than it has been paying for an awful long time. But honestly, genuinely, if you think you're beating inflation with your cash, then good luck with that, because I don't think you are. And if you are, it is for the first time in, frankly, 10, 12 years that you're doing that. By contrast, you might, and I hesitate the might, beat inflation with bonds by a little bit. When I look what I expect for the average bond allocation over the next, 5 to 15 years. I think you might beat inflation with developed market bonds. Developing market, probably a better bet, but a bit more risk. As for equities, whether it's patently is more risk, but much more return too, your total return from equities, something I've talked about an awful lot, the fact that equities have that wonderful capability of having, but not just paying a dividend. And obviously some equities don't pay dividends, but many do. But you can also get capital appreciation too, much more clearly and patently than you would with many bonds. Now, I know some people will be clever and say, well, you can make capital gains with bonds if you buy them at the right times. Absolutely. But, good luck with that, because we all know that the main returns from bonds generally come from the fact that they don't go bust and they pay a regular dividend. Absolutely fine. But, you've heard me too many times talk about when you should be allocating to bonds and at what age and related. We can come back on that subject anytime you like. I guess what I'm trying to say is I'm still of the view that equity allocation is the centre for what anyone in their pension fund thinking over the next 5, 10, 15 years, as far as we can reasonably see and think about, should be centred on. Anyway, I thought I'd just talk a little bit about cash day, because I came across that interesting graphic and I enjoyed it, and I thought I'd just share that with you and give you a few of my thoughts. So once again, I haven't said this for a while, but once again, I've sort of told you so little, but now it's time to close. And thanks very much for listening. And I look forward to speaking with you again very soon. Goodbye.